Today we will talk about the forecasts we do with Levy Institute models. So I'll say a few words as an introduction for the common structure that Levy models share, and then I'll give the floor to Michalis to talk about the US model, and I'll say something about Greece at the end. The structure of both models is a three sectors economy, even though we have added some additional details to capture components of trade or components of the private sector demand. But basically, the accounting structure is the same for these three sectors. Now, this is not a transactional matrix. This is the social accounting matrix I mentioned in my talk earlier this week. And here you record payments in the columns and receipts in the rows so that you can be sure that the consistency requirements are met. And one of the major aims is to derive the financial balances that I've colored in the capital account row. So the NAFA, the net acquisition of financial assets of the private sector as a whole, in relation to the government surplus or deficit and the current account of the balance of payments. And these will be the result of expenditure decisions and saving decisions made by the different sectors. And as I also mentioned in my previous talk, in both models, output and GDP is demand-led. And we have a private sector demand which is very close to what you find in the text by Godley and Lavoie, Monetary Economics, which is that private expenditure is driven by real disposable income and the real stock of net financial wealth. And this implies that the stock of wealth to disposable income tends to converge to some stable ratios in the long run, but there can be perturbations from this stable stock flow norm. And in both models, we have found that these perturbations can arise when there is additional borrowing either from firms or from households, when you have bubbles in the housing market or in the stock market. They both increase private sector demand against what should have been given disposable income and wealth. And in some cases, we also estimated separately investment and consumption, making sure that they imply a stable private sector demand relative to wealth and disposable income. We have given particular attention to trade because the current account balance is one of the major determinants also of the financial balance of the private sector. And we have developed our own estimate of world demand using an index of the GDP of the trading partners, both for the US and for Greece. And we use the same type of weights also to determine price competitiveness in both models. And we have endogenized imports, usually also splitting them between oil imports and non-oil imports. And they're also driven by relative prices. We have endogenized all the components of government expenditure and revenues which depend on the business cycle, such as unemployment benefits on the expenditure side and the different type of taxes and social contributions, which will depend on the level of income, sales, and wages. And the other components of expenditure and the revenues of the government are treated as fiscal policy instruments. So how do we run our projections given this general structure? I think I should mention that inflation is currently exogenous in the model. and we can discuss this if you want in the Q&A at the end. Inflation until a few months ago was very stable, and this implied that it's not easy to determine econometrically a good explanation for inflation. Now, things are changing, and we will update our models accordingly, but at present, inflation is projected exogenously. So how do we run our forecast exercises? They obviously imply that we provide values for all the exogenous variables in the models, and these will be arbitrary assumptions on what's going to happen in the future. So in order to reduce this arbitrariness, we use as much as possible official projections made by institutions. So we use the IMF World Economic Outlook forecasts for the GDP of the trading partners and for inflation in the trading partners. We look at the CBO, the Congress Budget Office, for the projections of the components of revenue and expenditure of the US government, and similar estimates for Greece. And for other variables, we just project their recent trends. And finally, the last assumptions we make are based on the exercise we want to obtain. So we often, for the US, want to replicate the projections made by the CBO. And we usually find that these projections are inconsistent. And I will show you a similar exercise for Greece at the end of my talk. So what we do in our projection is to check how much usually the private sector should borrow in order to stimulate demand so that GDP increases as the CBO has predicted. One problem that we always have is, and that I briefly mentioned in my last talk, is that our models are built to make consistent thinking of what will happen to the balances, to GDP, employment, conditional on given policies and given shocks over a 2-3 years horizon. So they are not built to make good short-term predictions. But our target are usually politicians and the public opinion. And most politicians have no clue on how an econometric model works and a stock-flow consistent model works. So they judge us on our ability to make good short-term forecasts. And this is obviously a problem, which implies that a lot of additional work has to be done so that the models are as accurate as possible, not just in their consistency, but also in updating everything to the very last figure which is available. So having said that, I leave the floor to Michalis, and I will come back to talk about Greece later.
Good afternoon, everybody. Today, I would like to talk, after this short introduction by Gennaro, and present some preliminary results of our upcoming strategic analysis that is going to get published in the next couple of weeks. It's co-authored with Dimitri and Gennaro. And the idea of the strategic analysis every year, every time we write one, is to analyze the situation in the US economy and the prospects and different scenarios of what can be done to solve some issues that exist. So let me go. I'm sure you have seen some of the graphs that I will present in the introduction already. So I'll just go through them very quickly. This is the recovery of the real GDP in the last 4 cycles, right? So the blue line is the recovery of the 90s, the orange line is the recovery of the 2000s, and the gray line is the recovery after the great financial crisis of 2007, 2009. We see here, and then obviously the yellow line is the current recovery. We see that the current recovery has been pretty impressive, right? So it has been a V-shaped recovery, and within basically a year and a half, we are now 3% above the pre-pandemic level of GDP. We get a similar picture when it comes to the employment to population ratio. Still, the employment to population ratio has not recovered to its pre-pandemic level, but it has scored some very, very significant gains, and one can compare this with what happened in the previous cycle. So you can see that in the previous cycle, for example, after 10 years of recovery, the employment population ratio never recovered to its pre-crisis level in 2007. And this is, I mean, this sharp recovery to a certain extent is related to the nature of the crisis. So it's related to the pandemic. There were some shutdowns. This led to a crisis. And then obviously when there was a reopening, it was sort of expected that there would be some sort of rebound, sharper and quicker than in previous crises. But it also has to do a lot with the fiscal stimulus of 2020 and 2021, right? And this line show the net outlays and the net borrowing on the right axis of the federal government in the United States, and we see that in 2000 and 2021, government stimulus reached historic levels. So it was at the highest levels of the post-war period in the United States, and the level of the stimulus can only be compared to the wartime economy in the early 40s, although it didn't go as far. As a result, there was a very significant increase in the real disposable income. So this is the real personal disposable income here. The trend, this is the orange line is the trend for the previous cycle, and we see how much, despite the crisis, despite the drop in GDP, the real disposable income increased as a result of fiscal stimulus. Another interesting thing about this graph is the recent months here. So if we look at the last few months, the 2022 months, we see that despite what happened in the previous 2 years, the real disposable income now is below the trend, and this is a sign of fragility for the US economy. So this is the good side. On the negative side, the trade balance during the pandemic worsened a lot. So the trade balance is something that because of the role it plays in the three balances, we have talked about a lot in the past. What we see here is that in the years, in the 2 decades before the crisis of 2007, there has been a constant increase in the trade deficit, right? So the total trade deficit goes down. The total trade deficit goes up. The trade balance goes down. During the crisis of 2007, 2009, the trade deficit recovers, and then after the recovery of the economy starts in 2009, again we see an increase in the trade deficit along the pre-crisis trends at that time, right? The big change came in 2011 and is related to the shale gas extraction in the United States. So you see here that the light blue line shows the trade balance of petroleum products in the United States, right? And you see here that between 2009 and 2011, the deficit starts increasing. After 2011, because of the shale gas extraction, because of the production of gas in the United States, there is a complete reversal of the trade deficit, the trade balance in petroleum products, and it's this reversal of the trade balance in petroleum products that basically maintains the overall trade balance relatively constant over the previous cycle, over the last 10 years or so, despite the worsening in the balance of the rest of goods, in the trade of the rest of goods. At the same time, though, the trade balance in petroleum products has sort of stabilized around zero over the last 10 years. And what we see here, we see that over the last 2 years during the pandemic, there is a very, very significant worsening of the trade balance, which is approaching its lowest level since 2005. This is an important development, and I will explain in a few minutes why this is an important development. You have heard a lot about inflation, and let me just also talk just a little bit about it. There was a panel in the morning, so there is no reason to talk too much about it. This is the graph for the consumer price index, and this is, as we all know, the very sharp increase in inflation over the last year or so that has reached now 8.5%. So this is the latest data that were announced last week. These are the different sectors. So this is the CPI. This is a consumer price index by expenditure category, right? And we see here how inflation, and this is something that was discussed in the morning, is concentrated in some very specific sectors, right? So it's mostly energy, right? New vehicles, used cars and trucks, airline fares. These are the biggest, these are the sectors, these are the expenditure categories that have experienced the highest rates of inflation over the last year. And then if we look at the contribution of each expenditure category, and the contribution, basically you just weigh the inflation of each sector, of each expenditure category with its relative weight in the consumption basket, right? We see something that was also discussed in the morning, that there are like a few sectors that have contributed the most to the overall inflation rate. The first one is energy. The second one is food. Then we have new vehicles, used cars and trucks, transportation services, airline fares. These are all expenditure categories that are, I'm showing this graph because these are all expenditure categories that are relatively unrelated to the state of demand in the US economy, and they're mostly related to the disruptions that came from the pandemic, like the increase in the cost of transportation services, or the increase in the energy prices, again because of the recovery out of the pandemic, the war in Ukraine, and this can also explain the increase in the inflation rate of food, right? Meaning that if one looks these expenditure categories, it's hard to say that the biggest part of inflation, this very, very high rate of inflation that we're seeing right now, is because the US economy is overheated. This conclusion also comes if we look at the average hourly earnings in the US. So in order to have inflation for a long period of time, you need to have this cycle between increasing prices and increasing wages. Right? This is the conflict theory of inflation that you might have heard. Again, what we see here is that wages, nominal wages, have increased during the pandemic, but they have not followed this spike of the price level. So again, this is a sign. I mean, it remains to be seen what's going to happen in the future, but this is a sign that the rate of inflation, unless we keep having price shocks from, I don't know if we have another war or what are going to be the developments in Ukraine in the next few months. But if we do not have more price shocks, given this, one would expect that the inflation rate would subside. I think this is another interesting graph. So this is this one and the next one. So these are the rate of inflation in the United States, the United Kingdom, and the Eurozone. And then the red line shows the rate of growth in these economies. The growth rate in the growth rate of their economies between the pre-pandemic peak and the first quarter of 2022, right? Until very recently. So what we see here is that, well, if one compares the United States with the Eurozone, right, one could say that, yes, okay, the Eurozone has experienced a lower growth rate, and because of this lower growth rate, it has a relatively lower level of inflation, especially when it comes to core inflation. However, if we make this comparison between the United States and the UK, this sort of argument breaks down, right? So the UK, despite having a much lower growth rate compared to the US economy, it has experienced higher levels of inflation, right? Overall, and this is a sample from different OECD countries for the period 2019 to 2021. And this is, so in the horizontal axis is the GDP growth rate. So it shows what is the growth rate of GDP in these 2 years, 2020 basically and 2021.
Is that nominal or real?
It's real GDP growth rate, right? And then on the vertical axis is the rate of inflation, right? So if we look at this graph, it's very hard to argue that there is a positive correlation between the GDP growth rate as a proxy for how overheated the economy is and the rate of inflation. So the rate of inflation is all over the place, meaning that there are other factors, other structural factors that can explain the inflation rate more than the fiscal stimulus and how the economy, if the economy is overheated or not. So this is, as a way of introduction, let me just go now to the scenarios that we are simulating. We are simulating in our report. As Gennaro mentioned, a usual practice in our strategic analysis is to base our baseline scenario on the budget and economic outlook of the CBO that is published every year, right? So the CBO, the Congressional Budget Office, every year publishes this budget and economic outlook, where it provides a forecast about the federal government deficit, the federal government outlays, the federal government revenues, but also at the same time about the growth rate. They also provide a forecast about the growth rate of the US economy, right? So the idea is, and obviously they're using a very, very different model compared to our model. So they're using a neoclassical DSG model which becomes supply side in the long run. Like, it's very clear the structure of the model if one looks at their projection. But an interesting exercise that one can do with our model, which is a Keynesian stock flow consistent model, where the financial side plays a role in the short run and the long run, is if we take the projections of the CBO and given the structural features of the US economy, meaning, let's say, how much exports and imports of the US economy react to the economic conditions in the US and elsewhere in the world. What does it take for these projections to materialize, right? So in this case, for example, these are the projections of the CBO for the next few years. You see that in 2022, the CBO is projecting that the government deficit will shrink very, very rapidly compared to last year, right? So you see in the first column that in 2021, the deficit was 12.4%, and the CBO is projecting that the deficit will go down to 4.2%, an 8-point decrease in the deficit, right? And then the deficit will remain more or less at this level for the following years, right? Around 4%. At the same time, if we go to the fourth column, we see that the CBO is projecting that the growth rate, which was 5.7% last year, it will decrease, but still remain significant at 3.8%, then 2.8%, and then it will converge to 1.5% by 2025. This 2.5% is what the CBO is, the implicit natural growth rate in the CBO model. So in all their forecasts over the last years, eventually their model, their economy, the US economy converges after 4 or 5 years to a growth rate of 1.5%, right? Which is, it is basically what the neoclassical model is telling you, that in the short run, demand can have some effect, but in the long run, you always have this convergence to the natural growth rate, which is determined by supply side conditions. They were more optimistic about the natural growth rate 10 years ago than now. But then when they failed year after year to reach this, when the US economy failed year after year to reach this growth rate, they just exogenously decreased their natural growth rate. Okay, so, and here now come the three balances, right? The idea is, how can you have this very sharp decrease in the government deficit, right? How can you have a decrease in the government deficit that will reach 4% more or less in the next few years, and at the same time, the US economy to have this very sharp increase in the trade deficit that we have seen over the last 2 years, right? And the answer to that, and these are the baseline simulations here, these are the three balances based on the baseline simulations, is that the only way to have that is for the private sector to turn into a net borrower, right? So you see here that, you know, our forecast and our econometric model for exports and imports show like a small increase in the foreign balance, in the foreign deficit, right? So you see that the blue line is slightly downward sloping. At the same time, the gray line shows you the government deficit along the lines of the CBO forecast. So you see this very sharp decrease in the government deficit from around 12% to more or less 4%, right? Now, the only way for these two things to happen is if the private sector turns into a net borrower, if the private sector starts running deficits. And just to put this into perspective, if we go back and we look at the data for the period after 1960, we see that traditionally the private sector has been a net lender. So you see that the way I have drawn this graph, the private sector being below the zero line means that it's a net lender, right? Because the private sector shows the investment minus saving. It's not the saving minus investment. So it's not the net lending that is shown in this graph, but it's the net borrowing. So a negative net borrowing means that the private sector is a net lender. Why we do that? Well, because it's easier to see the sort of the twin deficit, the twin positions between the government sector and the private sector, right? So traditionally, what do we see? Traditionally, we see that the government is running a deficit most of the times, and this deficit is mirrored with a surplus on behalf of the private sector. The only time that the private sector did not run a deficit over the last 60 years or so is the period before the crisis of 2007, right? So if you see here the years after the mid-90s and until 2007, this is the period here that the private sector is running a deficit, right? So essentially, and this is the result of our baseline scenario, essentially, if we want the private sector, if we want the CBO projections to materialize, given our model, right, this implies that the private sector again will start to run deficits. And obviously this has stock implications, and if this happens, this is the projected trajectory of the private sector debt to GDP ratio. We see here that if the private sector becomes a net borrower, obviously its debt to income ratio will start increasing again more or less with the same pace as before the 2007 crisis, right? So this is what it takes at this point, given the high trade deficit of the US economy, to achieve the growth rates that the CBO is projecting if the government consolidates its budget at the rate that the CBO is projecting. So these are the baseline simulations. Another issue that we have highlighted in recent reports, in recent years, and in the period before the pandemic, is that over the last decades, we have seen within the US economy the parallel development of two Minskian processes. So one is related with the asset price inflation. So there is a growing divergence of stock market prices from output prices. And the other is the increasing fragility in corporate balance sheets, right? So Minsky famously talked about the hedge, the speculative and the Ponzi position. So we have seen that at the same time over the last years, there has been this development of these two Minskian processes. These developments, these processes have been facilitated by the loose monetary policy of the Fed, right? And because the US economy has become more and more fragile from a financial point of view, it has also become at the same time more and more vulnerable to the tightening of monetary policy, right? Let me just show you a couple of graphs, a few graphs to make this point. So this is the Shiller price to earning ratio for the stock market in the US for the period 1881 to today, right? You see the correction in the market at the very end of the sample here. This is the recent period, but you see that despite this correction, this index is still at the height of the 1929 bubble. So we are still at the levels that the stock market was in August and September of 1929, and it's only below the level that it reached in the late 90s before the collapse of the stock market. This is another measure of the stock market valuation. This is the ratio of the market capitalization to GDP and profits, right? So the blue line is the ratio to GDP. The orange line is the ratio to profit. This is index, so this is normalized to 100 for 1975, right? If we look at this measure of market valuation, we see we don't have data to go back to 1929, but based on this measure, we are way above the level that the stock market was in the late 90s, right? Before the stock market crash of that period. When it comes to the corporate balance sheets, these are the data from the financial accounts of the Fed. So this is the ratio of the liabilities of the non-financial corporate business to GDP. We see here that there has been an increase, like a sort of secular increase in this liabilities to GDP ratio since 2000. This increase continues during the previous recovery. So while households try to deleverage after 2009, businesses kept increasing their liabilities, right? Today we are along this trend. So there was a spike during the pandemic, there was a reduction, but overall we are still along this trend of a pretty sharp increase in the liabilities to GDP ratio of the corporate sector. Other measures, this is the gross leverage of the US corporate sector from some reports of the BIS. Again, we see a very sharp increase in the leverage of the US corporate sector. This is the average percentage of investment grade corporate bonds in corporate bond mutual fund portfolios that are invested in bonds. Again, what we see here, these are data from the same report. we see that the bonds rated A, the share of bonds rated A has been decreasing, while at the same time the triple B rated bonds, which is the category just above the junk status, has been increasing. And this is the share of the zombie firms. I don't know how many of you have heard about zombie firms. So zombie firms is a definition that is given by, I think it's by Ricardo Caballero, who's at Harvard. The definition of zombie firms is firms that cannot cover the interest payments on their debt from their income, right? So it's obviously an analogous definition to what Minsky calls the Ponzi firms, although in this literature of zombie firms there is not much of a reference to Minsky. Again, if we look at the share of the zombie firms, these are data that go up to 2015 from a previous report of the BIS. We see that there has been an increase in the share of the zombie firms, right? So these graphs that I showed you and these reports that I cited, they paint a picture of an increasing financial fragility of the US economy. A financial fragility that is related to two processes that have been emphasized by Minsky in his work. One is the asset price inflation, the other is the fragility of the balance sheets. So the question is, what happens now that Fed starts tightening? And as I said, these processes have been facilitated by the monetary policy of the Fed. They have been supported by the monetary policy of the Fed, both by the low interest rate, but also through the very aggressive quantitative easing, the very aggressive direct purchases of financial assets on behalf of the Fed. So now that this support is solved, one can assume that we are reaching, a turning point where this financial fragility will show up, right? And to evaluate the potential effects of such a situation, we simulate scenario one. We simulate another scenario. And this scenario simulates a situation where the stock market falls until the end of 2022 and then stabilizes. And the fall in the stock market is accompanied by a decrease in private expenditure on behalf of households and firms, right? And this is what we get in this scenario one. So we see here, let me go here, we see here that instead of this 3.8% growth rate in 2022, the growth rate is now 1%. Then in 2023, we get into a recession, which persists in 2024, and we only recover in 2025, right? So this is a crisis which is comparable to the crisis in the past, especially to the recession of 2007, 2009. Obviously, the exact magnitude of such a crisis will depend on the exact decrease in private expenditure and the exact degree of the correction of the financial markets, right? Which is not something that one can predict with very much accuracy, but nonetheless, we think that it is likely that such a scenario will play out in the next few quarters and years. And these are the main sector financial balances according in this scenario one. You see here that because the private sector does not increase its expenditure in the way that it had to in the baseline scenario to achieve the 3% growth rate, the private sector never becomes a net borrower in this scenario. And then because of the decrease in private expenditure, we see that the balance of the private sector is improving. At the same time, because of the low growth rates, the current account balance is improving as well. But at the same time, there is also an increase in the government deficit due to the automatic stabilizers that come into play. What about inflation? In this scenario, inflation will most likely decrease, right? So in a way, one could say that Fed would be successful in reducing inflation. However, this decrease will not be the result of some sort of smooth transition towards a hypothetical Nairu, which is sort of the theoretical justification of the policy of the central bank, but will come at the cost of basically a full-blown financial crisis, right? So if we are willing to experience another financial crisis, then just to fight inflation, then let's do it. But this is what needs to be done to fight inflation at this point. If we believe that the Fed has to deal with inflation. Okay, and let me just show you another couple of scenarios that we have simulated. The motivation for these scenarios comes from proposals that have been put forward by Bernie Sanders or Elizabeth Warren to increase the tax rate of rich people, of high-income households. So the idea of these scenarios is that there is a 10 percentage point increase in the average tax rate paid by the top 1%, right? And then at the same time, this increase in the tax rate is taxation is accompanied by an equivalent increase in government expenditure, right? So we base the calculations that we do on how much tax revenue such scenario could collect on the distribution of on the data from this CBO report on the distribution of household income for 2018, right? So if one does the calculation, then one ends up with an increase in fiscal expenditure around 1.2% of GDP, right? So we simulate two scenarios. Scenario two, in scenario two, this is a pure government deficit scenario, meaning that government expenditure increases by 1.2% of GDP as a counter-cyclical policy, as a policy to finance this Families Act that was proposed last year and it didn't pass Congress, and so on. So this is scenario two. In scenario three is sort of a balanced budget scenario, which is what I was talking about before, meaning that you increase the tax rate for high-income households, and then this increase in tax rate is accompanied by an increase in fiscal expenditure, right? Obviously, because high-income households have a relatively low propensity to consume, this loss of revenues on their behalf is not, fully represented in the loss of consumption expenditure, because their marginal propensity to consume is relatively low. So this is what we get when we simulate this scenario. This is so the blue line here is showing you the increase in government expenditure. As I said, the increase in government expenditure is around 1.2% of GDP. In the purely deficit finance scenario, we see that the GDP by the end of our projection period increases close to 1.8% compared to the baseline simulations. But even in what I call the balanced budget scenario, which is the gray line here, again, because of the low marginal propensity to consume of high-income households, can give you significant macroeconomic benefits and a significant increase in real output. And these are the main sector balances as compared to the baseline in scenario two. We see here that obviously government deficit increases. So the gray line, which shows government deficit, you see that there has been an increase in government deficit. There is an improvement, though, at the same time of the private sector balance, and there is a slight worsening of the foreign balance, obviously because the the growth rate of the economy is higher in this scenario compared to the baseline scenario. So last slide, and I will stop here. What I showed you is that the US economy has recorded an impressive recovery over the last 2 years, and this is something that it's not much appreciated. Like everybody's talking about the inflation, but not many people talk about the impressive recovery. On the downside, there is a very significant increase in the trade deficit and inflation. Given our baseline simulations, what I showed you is that because of this increasing trade deficit and because of the consolidation of the fiscal expenditure, the US economy will find itself in a situation similar to the situation in the late 90s and early 2000s, and it is becoming increasingly dependent on the private sector becoming a net borrower for growth. There are risks for a financial crisis, and at the same time, as I showed you in scenario 2 and 3, fiscal spending can help and can be used also if we have another downturn, even under a balanced budget scenario, if the rich households are taxed. Finally, and this is another, this is a point that not many people talk about, because if you talk about the United States, you tend to forget the rest of the world. There are also important other side effects of monetary tightening for the rest of the world, and especially for developing countries. So there is clear evidence that there is a high debt accumulation in many developing countries, and like it happened in the early 80s, a sharp increase in the cost of borrowing for developing countries can lead to debt defaults and serious economic crisis in that part of the world. And then, to a certain extent, this may backfire and also affect the US economy or developed economies. So that's all I had to say. Thank you.
Okay. So I'll go quickly to leave some time for the Q&A, and I want to illustrate something about Greece, and I expect that not all of you know what happened in Greece, so I have prepared a few slides to summarize what happened. And basically, you can see that Greece went into a period of rapid growth in the last part of the 90s and in the first period of the euro. Then when the Great Recession came, Greece was hit hard, but not harder than other countries. But then Greece entered into a financial crisis of its own because the government debt was found to be higher than expected, and the deal which was made with the European and international institutions was for austerity. And at the time, the IMF, the World Bank, the ECB thought that austerity would not cause a dramatic drop in GDP, but this chart shows exactly that this was completely untrue. And Greece had a fall in GDP per capita, which has never happened elsewhere in peacetime. And the drops stopped around 2012. It started a slow recovery that was stopped again by the pandemic. And it is now slowly going back to where it was before the pandemic. Now, the narrative of the mainstream is that the Greek crisis was due to a large government deficit and therefore government debt, but we have documented in a number of strategic analyses that the real problem was the large current account deficit, which had implied in the years of the euro as an increase in private sector borrowing. So you can see that the private sector balance went negative because of the current account deficit, and that was the main problem with Greece. With austerity, the government deficit was brought down, and at the same time, Greece entered into a period of stimulation of exports, mainly exports of services and tourism, to try to get to a recovery. But one of the features that were driving the GDP increase was also investment in dwellings, as you can see from this chart. And the investment in dwellings never recovered from the crisis. Other type of investment did not drop so dramatically, but they are not as large as the investment in dwellings was in the first part of this chart, and therefore cannot contribute to a full recovery of GDP. As I mentioned, Greece adopted an austerity policy so that the government expenditure became pro-cyclical, and it was part of the reason why real GDP kept falling. And government expenditure was kept at a very low level up to the pandemic. Only with the pandemic, consumption and transfers were used to alleviate the problems of the lockdowns and so on. Also, as I was mentioning, the only component of demand which started to recover were exports. So exports of services increased at a slow pace, but very steadily. Exports of services, exports of goods also increased, but this increase is mainly due to intersectoral trade, because Greece is refining oil, so it's purchasing oil from oil producer countries, refining it and selling it to other countries. So as you can see in the last part of the chart, when exports of goods increase, you also have an increase in imports of goods, which sometimes is even larger, and therefore does not provide net stimulus to aggregate demand. Inflation was brought down by the crisis. Greece had periods of falling nominal and real wages. And to come quickly to the current days, also in Greece, the CPI has been growing very fast, but this has nothing to do with the labor cost. So in the black line is the OECD measure of unit labor cost, and you can see that it's not been increasing, it's actually been decreasing. While what is happening is that the price of imported goods, and these will obviously include oil, has increased dramatically. So this is completely imported inflation, and since wages are not rising as fast as the prices, this is will also bring down the aggregate demand, aggregate consumption. So very quickly, I wanted to compare the projections made by the IMF in the World Economic Outlook to what our model is projecting. So this chart is based entirely on the IMF projections, and you can see that they are quite optimistic, and they believe that output will go back with a V-shaped recovery to the trend that it had before the pandemic, with quite a quick increase. How is this increase to come about is not so clear from the IMF projections, because here I have reported the government current deficit, which is predicted to shrink and to drop towards zero. At the same time, the IMF is not so optimistic on the dynamics of the current account balance, which is in negative territory and improving only a little. So the IMF does not draw the implications for the financial balance of the private sector, but they are quite obvious. If you reduce the government deficit and you don't improve the current account balance, then the private sector balance will go again in negative territory, and either the private sector has to run down its financial assets, or more plausibly, it will have to increase borrowing, and borrowing will mainly be from abroad. So if this is the type of determinants of the growth rate that the IMF is projecting, is going to be very vulnerable and very likely to generate another crisis. Now, I prepared this for this talk, and we will revise these projections in the coming weeks to produce another strategic analysis for Greece. But in the first attempts I've made with the Greek model, I'm not as optimistic as the IMF. So here, as I said in the introduction, I've taken the projections for GDP of the Greek trading partners, what is expected for the government, and also what Greece should expect from the European Plan for Recovery and Resilience, which is this huge plan to provide funds to countries which will need to be paid back after 2027, if I'm not wrong. And for Greece, they will provide a strong injection of liquidity. So I've included an estimate of these funds for 2022, but I've also assumed that given the large government debt that Greece has, part of these funds will substitute for expenditure that the government would have made anyway, and that the government will choose again a strategy of austerity to try to keep reducing its debt. So if this is the case, and if no further funds materialize after 2022, this will imply another fall in GDP. So basically, one possibility to avoid this decrease is an increase in private expenditure or mainly investment. But it's difficult to think that given the circumstances of the high imported inflation, the war in Ukraine, etc., that this will materialize. And the implied financial balances of this baseline simulation are reported here. So we also expect the financial balance of the private sector to become negative in 2022 if the government shrinks its deficit. But since we are more optimistic on the drivers of the balance of payments, then we expect that the negative NAFA will only last for 1 year, and the situation will not be so fragile as in the IMF forecasts. So I was very quick, and this exercise is very preliminary, but I just wanted to give you a taste of how we compare our projections with those of other institutions.
Pretty rosy forecast we got there. Is there a direct link? You know, we noted that the CBO projects the U.S. Budget deficit to drop 8 points from 12% of GDP to around 4%. And obviously, we've talked about how the stock market is down substantially this year. Is there like a causal link there where, you know, if like households are the ones with the surplus that own shares in stocks of companies, you know, if we're removing that surplus by way of taxation or something, that would sort of force a sale, like that sort of downstream effect of the budget tightening causing the stock market decline, or at least contributing to it. Thanks.
I need this to.
Yeah. So
Yeah. Okay. The question is about the CBO model or our model?
About your model. Well, more of a general question, but also like, what were the inputs for the assumptions that you made for the stock market performance for the full year of this year?
Well, the CBO model is a new Keynesian model, right? It's a new Keynesian neoclassical model. Now, a new Keynesian neoclassical model means that, and this is very explicit in their forecast. If you read their tables, you can see that the growth rate can sort of vary depending on policy or other conditions of demand in the first couple of years, maybe 3 years, but then it converges to what they model as the natural growth rate, essentially, right? And then it stays there for the rest of their projection period. So this is very explicit. And the thing we know about these models is that things like aggregate demand or the stock market, they can only play a role in these first 2 years. So then the long run projections are completely unaffected by finance, by debt, by things like that. It's only basically productivity and population growth rate that drives growth in the long run, right? Meaning that, and this is one of the advantages of our model, because if you try to see what are the requirements for this growth to take place, you find that, well, for this growth path to take place, for this GDP path to take place, you need the private sector to be a net borrower, right? And then, because flows accumulate into stocks, the private sector being a net borrower, that means that the private sector increase their debt, their level of debt, and their debt to income ratio, right? Meaning that essentially, and this was the main argument of Wayne Godley in the 7 Unsustainable Processes, that, it was saying, well, the CBO is projecting, back then it was a 2.5% natural growth rate. So the CBO was projecting that the US economy would keep growing at a 2.5% rate. And he said, well, for this to happen, and given what we're seeing right now, given what we see about the current account balance and the fiscal tightening that was taking place at this point from the Clinton administration, again, you need to have the private sector running deficits. But if this happens, the debt to income ratio will increase, and this is unsustainable. Remember the definition of the stationary state we gave at the lab the other day, right? That you cannot have an increase in the debt in the stock flow ratios forever. At a certain point, this has to stop. So that's the point. In our model, these issues that you mentioned, like the stock market or the debt or the financial assets of the private sector, they play a role. So they are some of the main determinants of the private expenditure decision in our model.
Very interesting results and forecasts. In terms of the modeling, I would like to know the role of the interest rate. I know that you have a consumption function. I would like to know if you incorporate the interest rate there, and also in the investment function. Because in the morning, Professor Randall was saying that Steve Asari considered that the interest rate doesn't play an important role in investment. So I would like to know if you encounter in your model if the investment is affected by the interest rate. And the second question is the value of the marginal propensity to consume for both countries. You have the values for them. I mean, just to compare both countries. the marginal propensity to consume for Greece and for the United States, the values, you remember?
Well, yes, well, the interest rate, first of all, we have a private expenditure function, which is putting together investment and consumption. And we have tried very hard to find an empirical link with the interest rates, but we have not found any. So if we look at investment in dwellings, in models which have more disaggregation, and then you do find some evidence, maybe the link between the interest rate and demand for mortgages or the demand for housing, but not for the private expenditure as a whole. And for the propensity to consume, again, the equations have private expenditure as a whole, so you don't have a specific propensity to consume in the model. They can be estimated separately. Michalis, if you want to add something.
No, maybe it's not clear. It was not clear in the Levy model, and this follows what came to be called the New Cambridge approach that was developed in the Cambridge University by Wayne Godley in the late 70s. The private sector is treated as a whole, right? Therefore, you have the private sector, and then you have the decision about private expenditure, which puts together consumption and investment, right? Which is one of the main reasons of what Gennaro said before, that it's very hard with such a model to make short-term predictions. Sometimes we split that, and we try to estimate the consumption and investment function separately, but overall, the main structure of the model is built in a way to provide sort of medium-term forecast, and that's also why our analyses are called strategic analysis. So the character of this forecast is more of strategic, meaning that it highlights the main structural issues of the US or the Greek economy, and it's less aimed towards providing short-term forecast.
If you consider the overall expenditure, you don't consider the interest rate inside the model?
Well, the interest rate plays a role in the model. In the private expenditure functions, which is one of the main behavioral functions of the model, and which is estimated based on data, as Gennaro said, we have tried like different specifications because we estimate it, right? We have tried different specifications, and we try to find if the interest rate has an effect on private expenditure. It's really hard to find it in the data, and therefore it doesn't play a role. Otherwise, the interest rate plays a role. For example, it plays a role on how much the government transfers to households that hold government debt, or even to the foreign sector. So if the interest rate increases, you have this sort of transfer.
And the values, the marginal propensity, you remember the values for the US and Greece?
But as Gennaro said, because we don't have the consumption function, there is not a marginal propensity to consume. There is probably a marginal propensity to private expenditure out of disposable income, right? So for scenarios that we simulate, sometimes like this scenario that we say, okay, we increase the tax rate for the households at the top 1% which have a low propensity to consume. In this case, we do some parallel calculations, and we incorporate this calculation in the model. So the assumed marginal propensity to consume in this case is 0.2 for the households at the top 1%, which comes from the literature. So it comes from other sources that they have tried to estimate this propensity to consume.
For Greece, we have a specification for consumption, and the long-run marginal propensity to consume is 66% of disposable income.
Firstly, thank you very much for the presentation. That was really interesting. My question is more on the first section of your presentation. I remember one graph with the composition, the composition of inflation and the different parts that they contribute. Of course, food and energy were two very large parts, but I remember shelter had a very strong contribution. Is that because of a pass-through from the higher interest rates, like the mortgages, or do you know any other factor that has contributed to such a large increase to that factor?
Shelter is one of the factors that probably the only component of inflation that is not directly related to the pandemic and the war in Ukraine and so on. So one could say that shelter is because there is now a lot of demand for housing and the supply is not there yet. Okay. But if you how can I put my presentation here? Is it? It's already here. Share screen. Okay, I have to share screen. Sorry. Yeah, I can share the whole thing. So this is the contribution, right, of each category. And what we see here is that, yes, shelter has played a role, and it's important. Like, it's out of this 8.5%, it's 1.6%. But then the remaining 5-6% is directly related to sectors that are affected by the disruptions of the pandemic, the war in Ukraine, and the commodity super cycles that started after the pandemic. So this 6%, this part of inflation, it cannot be directly controlled by the Fed by increasing the interest rate, unless the Fed engineers a big financial crash. In this case, yes, maybe this is going to happen.
Gennaro, have you run a model for Greece, assuming either in 2010 or now that there was greater capacity for fiscal flexibility, to see what that would look like?
You mean a greater capacity in terms of a counterfactual? So what would have happened if the government had spent more?
Yeah, so let's say in 2010, rather than the reaction we had, which was Greece is manipulating its finances, we must enforce the validity of the Stability and Growth Pact, we imagine a world where instead Greece can essentially implement whatever government spending policy it had felt was in its best interest at that time.
Well, we have not done this exercise, but you know well that Greece is in the Eurozone, so it is no longer a sovereign country in the MMT terms. So given the large current account deficit, it had to, and the absence of its own currency, what we have estimated and played around was what would have happened if Greece rather than what would have happened if the government spent more. And the results were quite interesting. So with the parallel currency, the government could avoid the default on its foreign debt and at the same time stimulate the domestic economy. Varoufakis had a plan which they did not let him implement it.
Can I add something to that? I was involved in the Greek model until a few years ago. I think one of the results that we found during the period of harsh austerity back in 2013, 2014, like the main result that we would find is that the fiscal targets and the growth targets of the Troika were incompatible. Right? So you would either go for the fiscal targets, meaning the fiscal consolidation and the decrease in the government deficit that they were trying to do, or you would go for the growth targets, right? You could not, at least based on our model, and I think we were sort of reality was in our favor. Unfortunately, this came to be true, meaning that if you would relax the fiscal targets, you would have higher growth rates. But unfortunately, Troika went for the fiscal target, so they didn't care about how much the economy would collapse, but they achieved the decrease in the fiscal balance that they were projecting.
Did you have for the U.S. forecast? Anecdotally, I've been hearing and reading about companies talking about increasing capex and both last year and projected to for this year. Are there any special assumptions that you use for capital spending of U.S. firms, or is that going to be constrained by the fiscal tightening and the large current account deficit? Thanks.
No, as I mentioned before, private spending is determined from the private expenditure function of the model. So it's a behavioral function. And in turn, like the main determinants of private spending is GDP or disposable income and the real accumulated wealth. And then, some other small things that we have put, like how willing are households and firms to increase their debt to income ratio and things like that. Meaning that the private expenditure function, the private expenditure decision is endogenous, and you estimate the private expenditure function, and then the model tells you what the private expenditure is going to be.
Something I think I missed. You were talking about when he was asking about the propensity to consume, and you said that I think you said it's difficult to separate consumption and investment. So in one of the models, you don't have a consumption function. You have the other thing, but in one of the models, you do separate them. I think it has to do with the length of the horizon of the model. Which is which? I just wanted to get that clear.
Well, it's basically very pragmatic.
Oh, okay.
It's basically, from my point of view, it's very pragmatic. So we want the model to have stable stock flow norms. So in the last years, we had very strong shocks to the economy. And especially the pandemic shock is very difficult to deal with from an econometric point of view. So if the private expenditure function does not provide very robust results, we try estimating separately consumption and investment. And we've done this for Greece, and in that case, we had better results, so we switched to separating the two components. But the type of estimates we have for consumption and investment are such that they still imply that the private expenditure as a whole has a stable norm with the net financial wealth of the private sector. So the two approaches are comparable.
Right. Yeah, this is like, remember this consumption function that we discussed in the model sim the other day, right? We didn't have time, but this consumption function implies that households want to have a stable stock flow norm. So their net wealth as a ratio of their disposable income should be stable, right? And this is an observation that Wayne Godley had made for the private sector as a whole. Meaning that if you look at the data in the national accounts for the private sector, he observed that the private sector as a whole would tend towards such a stable stock flow ratio. So that's the sort of the theoretical justification for using a private expenditure function, which is a private expenditure function analogous to this function that we saw in this model sim the other day. Meaning private expenditure is a function of disposable income and wealth, right? And then, as Gennaro said, in certain applications, like for certain scenarios or for certain questions that one might have, maybe you want to distinguish between the consumption effect and the investment effect. Right? In this case, we do some side calculations and we estimate separately the effect. Like we make separate projections for consumption and investment. Well, thank you very much.